Hey everyone, Mark Panzon here, partner and mortgage broker with Mortgage Connection. Hope you're having a great day. Hope you had a better weekend. Time for another market update. So last month we talked about the bond yields, the variable rates, fixed rates, inflation. This month I want to talk about or just provide a quick update on the interest rates. Then also I want to show you a really great tool that we have to sort of show you what your payment, what the interest cost will be, what your balance will look like as interest rates start to come down, and when you can sort of start to think about fixed versus variable and maybe which one might make more sense going forward. So without further ado, let's start with the charts. So last month, early November, we talked about the current bond yields, the 5-year bond yields. And as a quick refresher, the fixed mortgage interest rates follow the 5-year Canada bond yield. So currently, this is the 5-year Canada bond yield. We've seen a continuous drop since about early October. And then last month when I did a video, early November, we were right around 4% in the bond yields, and we're currently now down another 0.5%, 3.5% for the bond yields. So fixed interest rates don't always follow the bond yields like dollar for dollar. But when there's drops in the fixed rate market. Sometimes it takes a good run of drops for the bankers to react to drop their rates, but it's pretty close. So 0.5% drop since the last meeting, which is great news. If I bring up that golden and death cross, which I had on last month, nothing's really changed in that scenario either. We have this death cross, so that's when the 50-day average crosses the 200-day average. When that happens, if this was a stock, you'd want to sell that stock. But since this is a bond yield and we want things to go down, we want rates to go down, this is a great thing. And it hasn't crossed back over. It hasn't crossed the red line over again. Usually when it crosses back over, you see a different signal. You see the golden cross, I guess, but I have them green. So we're looking good. So things are good. So in the short term, we've had some continuous drops. It tried to kind of make a move up here, but it touched that line and came right back down. So all in all, fixed rates are continuing to trend downward, and that's a really great thing for fixed interest rates. If we compare that to variable rates, there's not going to be a ton of change here because variable rates haven't moved. So variable rates look exactly the same as they did last month. There's been no changes to the Bank of Canada rates since July. That's when the bank last made a change. And they're meeting again in 2 days for their final Bank of Canada meeting of the year. And by all accounts, everybody's projecting for them to not change the rate again and really start thinking about dropping rates as we get into next year. So the Bank of Canada overnight rate looks the same. Rates have been up. And of course, that's primarily fueled by how the inflation data comes through. So a quick refresher again, inflation peaked back here in June 2022. The Bank of Canada reacted with a number of rate hikes. Inflation's now come down. And so now this is going to start reversing. Fixed rates are already starting to turn. So we're just a matter of time before these variable rates start to turn as well. So all in all, great news on this front. Let's take a quick peek at interest rates. So without sorting the type of transaction, purchase, refinance, transfer, where you're located, the purpose of the transaction, your credit score, let's just look at best rates versus best rates and give you a decent range to understand where we're at. So there's really no change on the variable. We're still at that 6% mark. So prime rate is still 7.2%. So the best deal out there is prime -1 with a couple lenders, so 6.2. Which does range all the way up to 7. So some lenders aren't discounting as heavily as others, but in general, between 6 and 7% would be the cost of a variable rate mortgage today. If we look at the 5-year fixed, which is traditionally the lowest fixed rate mortgage versus other fixed rate terms, we're down. Obviously, the bond yields have been working down, so we're down to 5.2. A lot of the lenders are kind of right in the middle around 5.5%. Some of them a little more pricey, closer to 6%. But all in all, moving in the right direction and things are looking good. So knowing that interest rates are on the low end around 5%, really just one lender, most of them are closer to 5.5%, all the way up to 7% with some lenders on the variable. That's going to be your range. So what I wanted to do was just provide you with a couple different examples. So the first one, I'm going to talk about the variable rate mortgages. So this one is based on a scenario of a mortgage of $500,000 with a 25-year AM and a 5-year variable at the current rate. So if you were to buy a home today and selected variable rates, your payment would be $32.82. If you were to buy a mortgage and go with a fixed rate, and let's say you're sort of somewhere in the middle there, you'd be looking at about just over $3,000 a month. So what I'm going to do here in this video for this month is start to make the case that variable rates are back in play. So with that, I want to show you a couple things. So first, we'll go back to if you were to buy a home today or in the next 3 months, this is what you'd be set up with: $3,200 a month, $3,300 based on this purchase price if you have less than 20% down payment. If you have more, we can extend the amortization, the rate changes, but in general, just to keep it vanilla, this is where you're at. If the interest rate dropped by 1%, and you had a $500K mortgage at 25 years, you'd save $300 a month. And if it dropped by another percent down to 4.2, you'd save $588 from the first scenario. Now, this isn't cumulative. This is snapshots in time. So if you were to buy a home this year versus, say, next year versus the year after, you're just going to continue to save money, obviously, as that variable rate or any rate comes down. That's pretty straightforward. But wouldn't it be great to know what your payment would look like as your balance drops? So as your balance drops, as interest rates drop, how does that really affect the interest cost, how much principal you pay, and what your actual payment is? So for that, we have a great tool. Before I show you the tool, though, I do want to show you a quick projection on where we think rates will be. So we already know based on the charts that the data is pointing to rates coming down. So bond yields are dropping, and I'm not going to go into the deeper economic data, but things like unemployment is a big marker for the Bank of Canada. GDP is a big marker. So if unemployment keeps increasing, which it has, then that's a good motivator for the bank to drop rates. If GDP is minimal, around zero or negative, that's recessionary talk. The bank doesn't want to go into recession, obviously. So that's another motivator to drop rates. So those are the other markers helping, but in general, sounds like rates are coming down. The biggest thing I'm going to use to support that is the Bank of Canada Monetary Policy Survey. So this is a survey of 28 different economists, bankers, financial experts, and it's just a survey of where they think rates will go. We're going to go with the median amount of responses. So what do most people think? So right now, the Bank of Canada rate is 5%. We talked about that. That's the red line here, so it hasn't moved. 28 respondents believe that rate will drop a quarter point starting in April. So about 4 or 5 months away, we're going to start to see relief potentially in variable rate mortgages. And then we're going to see another 0.25% drop by July, another quarter in the fall, and then another quarter by end of year. So we're going to go from 5 to 4 is the general consensus between bankers. Now, some believe we're going to even be, percent half lower. But again, let's just go with the medium, the sort of safe response for now. And if you even look forward into 2025, we're looking at another 1% drop. We're going to go from 4 down to, say, about 3% drop. So we're looking at a potential 2% drop over the next 2 years. These estimates I don't think are really way off. It's just a matter of how quickly will they drop. Sometimes if different circumstances pop up, like war or COVID, sometimes it'll delay some of these measures. So assuming no crazy black swan events, this could be a pretty reasonable approach and estimation of where rates will go. So knowing that, let's bring in our other tool, which really puts this all into play, which is one of my favorite tools, thanks to our friends at RMG. So RMG Mortgages, one of our lenders, has come up with this tool that really breaks down the comparison of fixed versus variable and what your costs will be over time as rates drop. So again, same scenario, $500,000 would be your mortgage, assuming you buy this home in January. The standard 25-year AM, best rate today is at 5.19. You'd be paying just under $3,000 per month. If you compare that to the variable rate option today, at the best rate, which was prime -1, so that's 6.2%, you get $3,258. So roughly, what's that, $300-ish less per month if you go with a fixed rate now. However, given that we have those future rate drops in the future, it'd be interesting to see what your payment would look like and how much interest and principal you pay. So for that, we have this sort of chart, and we can pinpoint when these drops happen on the variable rate side, and then we can show you what it looks like. So for this, I just copied the Bank of Canada's estimate. So again, a quarter drop in April, quarter in July, quarter in September, quarter in December. That's your 1%. And then another 1% drop in 2025. So again, these dates might move around, but in general, we're looking at possibly up to 2% and staggered, not all at once, staggered. So your balance will change throughout the time. So what does this all mean? Well, in general, the variable rate mortgage would be the best decision based on your overall net savings of about $14,500 over the course of the 5 years. And really, we're just talking about 2 years of rate drops. So that's great news. And so the chart just further illustrates those rate drops and when you sort of break even. So the red line here is the interest cost on the fixed rate option. So obviously it's static, it remains the same and just gets lower over time. And on the principal side, the blue line, you just end up paying more and more principal as you get closer to the end of the term. The purple is the interest cost on the variable. So every time there's a rate drop, your interest cost goes down. So you can see it crosses over, and that's why there's a net savings on the variable. And then same thing for the principal, the green line, it just keeps getting better and better as you pay more principal as rates come down. So we're talking about 1, 2, 3, 4 rate drops before you're at this break even point. So that's the 1%. So roughly by end of 2024 is when it'll be a better deal for variable versus fixed. So if you have to buy a home in the next 3 months, selecting a fixed rate now will certainly save you money for the year. But it sounds like after 1 year, based on these estimates, you're going to start to lose on the fixed rate option and the variable will become more popular. So that's why I'm thinking it's starting to be back in play. And certainly you might be asking yourself, well, why don't I just do a 1 year fixed? Well, the 1 year cost is a lot higher than the 5 year cost. You're upwards of like 7-8%. And we can work that in the scenario, but in general, I think you get the picture that variable rate is back in play here. So if you wait the year, you start break even, and then you're gonna continue to save money in the variable as it continues to drop. Quick refresher on this as well that I think is worth noting. There's the 2 types of variable rate mortgages. There's a standard variable rate, and then there's the adjustable rate mortgage. And the adjustable rate mortgage is when the interest rate and payment change. And the variable rate mortgage, which only a handful of bankers have currently, is when the payment does not change when rates change, but instead your amortization will change. So for myself, for example, I have a rental property at CIBC, and they're one of the lenders that don't change the payment. So when rates were going up, my amortization was something like 13 years left on my mortgage. And because I didn't change the payment, it went all the way to 70 years. So I had to then increase my payment to keep up with it, and the amortization came back down. So most lenders don't do that. Most lenders change your payment with it, which is going to be great news as rates come down. Not so good as my rates were going up, but really good news as rates come down. So that's basically it. I just wanted to show you where rates were, the difference between fixed and variable, and then what the potential outcome would be if you select a variable and all these rate projections come true, and when that might kind of come true. And certainly, again, you can go back and you can look at a shorter term fixed, as I mentioned. Just be aware, if you look at, for example, a 1 year fixed, you're starting at high 6s and they get all the way up into right around closer to 8%. So, we can run the math for that if you will. If you have a specific scenario, we can certainly look at that. But in general, I think you get the point. Thanks so much for watching the video. Have yourselves a great day. If you have any questions, be sure to reach out. You can always find me at www.markpanzon.com or simply give me a call, text, email. Happy to answer any questions you have. Have yourselves a great day, and we'll talk to you later. Bye-bye.